Ce panel va traiter des petites capitalisations, donc des capitalisations en bas de 200 millions de dollars de market cap. Il y a eu un commentaire à cet effet qui a été donné plus tôt ce matin. Louis, peux-tu réagir là-dessus, sur ce commentaire qui a été fait à l'effet que...
Avec plaisir. Je pense que la personne qui a fait le commentaire, on se connaît bien, on partageait les mêmes philosophies quand on coachait au hockey mineur. Mais je pense que ça a évolué depuis ce temps-là. On est parti dans des routes différentes. Juste pour vous donner une petite idée, la première question, c'est quoi la bonne taille pour devenir public? Ça dépend de votre entreprise et le test, il est toujours le même. Est-ce que ton statut de société cotée en bourse va t'aider à accélérer ta croissance? Si la réponse est oui, on continue à se parler. Si la réponse est non, bien, tu continues à parler à ton capital risque ou ton capital privé, mais il n'y a pas de formule préétablie. La deuxième chose, c'est que le Canada, c'est le seul marché au monde où on peut amener en bourse des early stage companies. On a deux bourses, la bourse de croissance, le Venture, pour ceux qui la connaissent, cet acronyme-là. C'est 1700 entreprises inscrites. Et on a une petite bourse ontarienne qui s'appelle le Canadian Securities Exchange, sur laquelle on retrouve 420 quelques sociétés inscrites. C'est plus de 2000 entreprises qui ont des profils de capital de risque, qui ont choisi la voie des marchés publics plutôt que la voie traditionnelle du capital privé. Pourquoi on regarde, are we looking at public market if we're at an early stage? La nerf de la guerre, it's always the same answer. They're looking for financing. The venture companies raised last year $6.8 billion. Half of that was raised by resource companies, but we're still talking about above $3 billion raised by non-resource companies. On the CSE that you may have discovered through cannabis-listed stock, those 400 companies raised $5 billion, 80% of which raised by cannabis companies. So we're one of the only country in the world where you can approach private VCs, private equities, or if you prefer, you can look at public market and evaluate if the public market can be a good fit for your business.
Thank you, Louis. Could you give us some statistics about the number of Quebec issuers that are listed on the stock exchange?
On va tomber dans la tristesse. There's only 200 Quebec-based companies that are listed on Canadian exchanges. In terms of percentages, it's 7% of the total number of listed stock. If we're considered that Canada represents between 20 and 22%, it's easy to conclude that, going public is not part of the Quebec entrepreneur ADN. It was part of their ADN many years ago.
In the 80s, yeah.
But now we need to rediscuss or reopen alternatives for entrepreneurs.
Could you tell us what kind of issuer is a good fit to go on a stock exchange, to go public?
Most of the guys that we see knocking to the public market doors are those that are allergic to shareholders' agreement, veto rights, and who prefer dealing with 300 small shareholders compared to a couple of much more influential traditional shareholders.
Yeah. What do you think, David? What type of issuer is really a good fit to?
I think it really depends on kind of what the market sentiment is at the time. That ebbs and flows. We've seen a lot of success with health sciences companies in Quebec and early stage mining companies. In Quebec, there's some great emerging technologies. AI was referenced, blockchain. I think all of those right now continue to be fundable businesses.
Okay. What's hot in 2019 in the markets? And what do you see for this coming year?
Yeah,
in Quebec and maybe Canada or...
Yeah, it's much the same, Quebec versus rest of Canada in theme. I think we're still going to see a very active cannabis market in 2019. I think it's going to be much more selective than it was in 18. I think in 18, if you just had cannabis in your name, you were fundable. Now, I think you're seeing a lot more focus on to cannabis operations or cannabis companies with operations in the U.S., which over the last 2 years suffered from a valuation perspective. And then conversely, the Canadian names, operated names, really got to a bit of excess. And so we see the capital rotating now out of or slowly away from the Canadian names, the traditional LPs and so on, and moving more towards Canadian traded but U.S. operating. So I think that will be a theme. I think there'll be a lot of M&A in 19 in cannabis. We're active and we're part of that already. That started last year. It's going to accelerate. I think there's a lot of capital raised.
Cannabis.
In particular with cannabis, yeah. There's a lot of capital raised at substantial valuations, some of that or a lot of that done with convertible debt. And they're now looking down the barrel of maturities and longer than expected revenue profiles and certainly not profit profiles. And so I think you're seeing, you're already starting to see combinations occur, and I think you're going to see a substantial increase in that this year. Outside of that, there's still selectively on the health sciences front, there's interest. In fact, what I'd say is the balance of the market is really just a giant special sits market. There's no kind of sector where capital is just flowing in kind of with a lot of enthusiasm. Every kind of evaluation that is undertaken both with our institutional and individual investor clients is really focused on the name, the story, the near-term catalysts. Do they have a track record? A lot of scrutiny now. I'd say
on management.
On management, on track records, the investors are very, sentiment-wise, I'd say very cautious. We track sentiment institutionally and individually, actively. It's important to our business, and I think it's worth kind of remembering that the TSX Venture Index, and I'm not blaming you.
I'm not with them anymore.
It was down 35% in 2018, and compared to
the TSXV was 35.
The TSXV index, down
the
35%.
TSX was down 10.
Oh, the main board, right?
Yeah,
right.
the main one was
right. But the venture was very hard hit, and compared to December of 16, it's down 27%, and compared to December 15, it's barely up. It's about 5% up. So it's hard to be super enthusiastic about the venture junior environment right now. So even IPO-wise, in 18, I think there was about 110 IPOs done, which was a big increase, about 125% increase over 17. But they raised 27% less capital than 17. So more than double.
But there were RTOs too.
Well, there is definitely a resurgence of the capital pool companies coming back to market, so that does skew a little bit. We're also seeing a lot of companies come to market that they're coming way too early, and so they're listing with very small capital raises, or they're just filing listing statements and they're not raising capital at all, in the hopes that liquidity will magically appear and that their stock will go up and they can raise capital later, and that's a flawed strategy in our view. So you're seeing a big increase in the listings, a big decrease in capital. The market cap of the venture at the end of the year was $45 billion. It was $54 billion at the start of the year. So it's a pretty somber kind of macro environment for juniors. And so the confidence in business plan, management, catalysts is critical. If you come to market without being able to clearly articulate those and establish a say-do ratio, we talk about this with our clients all the time. You should be talking to investment banks early, well, not other investment banks, just ours primarily, but you should be talking to banks early before you go public.
We have somebody from the National Bank.
You need to start dialogues early so that you can start to socialize your business plan, your objectives, and then come back to them in 6 months and say, you know, I said I was going to do these things, and I did these things. And start to establish that track record, because to get an investment bank to sponsor you, you know, that is a big leap of confidence and trust. And to just kind of show up and say, I've got a business plan, a hockey stick forecast, and why don't we go raise $10 million, $20 million, in this environment is very, very challenging.
Talking about hockey sticks, maybe just to help, again, if you're an entrepreneur and you're trying to evaluate the junior market versus the senior market, we can say that the junior market is to the TSX what the American Hockey League is to the NHL. There's a lot of guys getting to the American Hockey League. There's only a few graduating to the pros. And you see guys in the American Hockey League who simply disappear after a couple of years. So the venture market is very similar to that. So you need to be able to, as an investor, you need to be able to distinguish the quality and the true companies from the fly-by-night. From the entrepreneur, I'm coming back to the 6.8 billion and the 5.2 billion. And you know, if you're able to attract some of that money, that could be a pretty good deal. And if you deliver properly on venture, the natural step is to graduate on a senior market, at which time you're going to reopen many, many horizons, and you'll be able to tap into different investors, attract different brokerage coverage, and so on. But
Louis, what are the listing requirements? Just to give us an idea on the TSX Venture and the TSX to graduate.
So that's the optimistic views. First thing we say about the listing requirements on a junior market, don't target them. They're way too low. The exchange basically at the junior market level is a number games. They're going to tell you your management is credible, legit, and knowledgeable about the business. We scratch the first box.
You own it also?
Eh?
We own it also?
You own your services, either directly or through licenses, another check in the box. You have a solid business plan, check in the box. Your capital structure makes sense. You're not trying to get 100 million shares for no value, another check in the box. The most important element is the financial resources. And they have a floating requirements in that regard. They're going to look at your business plan. They're going to ask you, okay, how much will do you need to spend over the next 12 months? If you're able to knock to their door with that amount of money, they're going to say you're funeral. Who would be crazy enough to go public with only 12 months of burn rate? I would certainly not. So you really have to look at how you're going to spend. And we heard the same comment earlier from other panels. Whether you're a VC, whether you're a private equity, or whether you're a public investor, the basic criteria are all the same. You want to invest into quality deals and quality people. If you're going on venture or the CSE with too little money, if you fall short of your milestone, you're dead. There's no second chance. If you have used, private equity, VC money, there's a likelihood that you may be able to tell them, guys, I screw up, but look, there's still something valuable. Give me a second chance, and you may be able to buy sometimes. On the public market, you screw up, your stock worth half a cent, and investors are now investing into David's next deal. So that's another
I didn't do that
difference.
last one.
Mario,
Yeah.
Could you give us some information about the financial statements and what are the requirements
So as part
for
of
a
the,
public company? Yeah, for a public company.
Yeah, so as part of the listing requirements, obviously what goes into the document or an eventual document that's prepared are financial statements. So the financial statements that a company would need would be financial statements, basically 2 years of financial statements, therefore, the income statement, the cash flows, equity statement, as well as 2 years of balance sheet and the notes that go with it. And the important thing about the financial statements is that they need to be prepared in accordance with international financial reporting standards, and the 2 years need to be audited. So they have to be audited. You can't just go on the public market without any audited financial statements.
How do you compare the IFRS rules compared to GAAP rule for somebody that is not IFRS?
For sure.
Is it complicated?
Sure. So there's obviously in Canada we do have two, actually more than two, but for private companies we have 2 different accounting referentials. So there's 2 different standards. One IFRS that needs to be applied for public companies, and there's ASPE for private companies. So IFRS is basically a step up from the private company GAAP, if I can say. And there is some, depending on the industry, depending on the accounting policy choices that were made in the past, there could be some differences in the accounting standards, but the big step up with an IFRS financial statement is the disclosure requirements. There's a lot more disclosure requirements for IFRS statements. So when you look at it and compare, I mean, sometimes private GAAP or private company financial statements, when transitioning to IFRS, will almost triple in size because of the disclosure requirements that are there for IFRS.
So you really need to think about that $6.8 billion because otherwise you don't want to go through that.
And just one other thing, in addition to audited financial statements, depending on the period you're at in filing the document, you're also going to need interim financial statements. So if there's a period that closes at an interim period, you're going to need year-to-date financial statements of the P&L, change of cash flow, and shareholders' equity statement with the comparative as well as the most year-to-date balance sheet. And that, of course, is not audited, but will need to be reviewed by the auditors in the context of filing with the TSX Venture.
Yeah, I had a situation where the issuer had nothing. There's only a mission d'examen for 3 years.
Yeah.
So if I call you, what could you do with that?
We're going to rush. We're going to rush for sure. But obviously, in that case, you have no choice. We would have to go back and audit it and plan it with management as much as possible to ensure that the audits get done as quickly as possible. And that, obviously, that's where a good planning in a company that wants to go public, a good planning is important, where you establish yourself in saying you want to go public in a year's time or 2 years' time, and you can work towards that objective so that you don't come at the end and say, well, I'm ready to go public now, but I don't have the financial statements that are ready to go. If in that situation, for sure, we'll need to do the audit. But also, if there's a build-up to something that we know we're going to go public in a year's time or 2 years' time, I mean, we can work hand in hand with the client and with our legal advisors and with their investment advisors to work towards a common timeline and objective and help them with, like I said, transitioning to IFRS, maybe implementing processes and controls to get to a point where after they're public, well, they'll be able to, quarterlies will come quickly and yearlies will come quickly, so they'll have the processes in place to ensure that that's done on a timely basis.
Okay, thank you. Maybe a question for Louis. How do you compare raising capital through public markets compared to going with venture capitalists or private equity?
I think I briefly touched it at the beginning. I guess the relationship and the expectation of the parties differs a lot. You're going public, you'll have to execute on your business plan, and you'll have to manage the relationship with the whole market, which means an investor relation communication plan. You'll need to invest into road shows. You'll need to travel. You'll need to try to convince those guys to look at your stock and so on. So it's a broader perspective. And as you mentioned, managing the public company side of the business means you need to be ready to prepare financial statement, MD&As, and all those things. So if you're ready to do that, then it's manageable. While the VC money will look more closely to you. Financial statement, you may have to generate them once a month rather than once every 3 months, but you have a one-on-one relationship. So for certain mindset, they're much more comfortable with the private relationship. With other mindset, going public is something that they prefer.
Exactly. That's my experience. There are certain entrepreneurs that won't want to have all those shareholders agreement documents, negotiation with private equity or something like that. And there are others that do not want to go to public market, make communicate by press release each time they do something or they do something else. So it depends on the personality of the entrepreneur, really. Yeah. There's not a bad or a good way to raise capital.
Yeah, and I guess that's important for the entrepreneur to really understand what they're getting into. You know, having to deal with the market, having to open the books and be transparent, having to disclose information that the competition doesn't have to disclose. Those are all things that you need to factor in going in. On the other side, if you're public, maybe you can use your equity as a currency for acquisition. We have seen companies being able to attract key resources because they were able to provide a public company stock option incentive plan to guys that the private guys have much more difficulties in getting it. The transparency sometimes also means that a potential client or suppliers can go on CDOR and see exactly what's your cash position. Will you be still operating in 3 months or 6 months? If you're private, due diligence and buyer beware. Public, there's much more transparency. So there's really both sides for different profiles.
David, how do you compare both ways of raising capital?
I think maybe my only couple of thoughts in addition would be, you know, when you're private and you have a private equity backer, you have, I think, the flexibility to be much more strategic and long-term in your orientation. As soon as you go public, we start to see companies become very myopic. They start becoming very short-term focused. They're anxious about how the market's going to perceive a certain transaction, which may be long-term is a fantastic accretive deal, near-term is going to hit cash flow, and they're anxious, and maybe they steer away from deals like that because they're worried about managing the market. So there's potential consequences in terms of your business focus from a time perspective. And then I think the other conversation that I know our banking team has often with clients that have gone public that have been maybe disappointed with that is that they still think of the relationship as one-to-one. So often the conversation is, well, you know, I said I was going to do these things. I did these things. I feel like my business is doing great. You know, why is my stock not performing? Why is it hard for me to raise capital? And the reality is you're not competing against your plan. You're competing with every sector out there, every other company out there, a hot cannabis market, and the capital is mobile and very fickle. So it absolutely, in many cases, has nothing to do with you or your business or your performance. But you're not, you know, you haven't been in a sector that's doubling every kind of 18 weeks. And that sometimes is hard to reconcile.
Okay. Mario, do you have any comments on that, on raising one way or the other?
Well, I think it becomes really, like we said at the outset, maybe more of a preference where, you know, where you have your appetite to be much more transparent, like Louis indicated, or where you have a little bit more control on the private side and, you know, in running your business and running it with, you know, with your private equity investors.
Okay. David, could you give us like a few examples of where Echelon was involved recently in Quebec or in the last 2 years in Quebec?
Sure. Well, we've
what type it will give an idea of the type of issues that works, or what's working, or what's
So we've been very active in Quebec because I think there's, for the reasons that we were discussing earlier, there's a bit of a gap between private equity and where the banks typically live. And there's not a lot of independent firms that, our second largest office is in Montreal. And so we've been very busy here. I'd say, you know, recently, for instance, we worked with Paul Raymond and his team at Alithia Group. And we were part of the team that raised $50 million via bought deal for them as they kind of went public and did that RTO.
I did the publication.
Oh,
I was
there you go. So we did that.
Yeah, we did that, exactly.
So those guys are pretty lucky. Alicia is the only Quebec-based companies that listed on the TSX in 2018. So, and you were both involved?
And sorry, what's special about Alicia was that they actually were one of the few that actually did cross-border. They actually went public in the US and in Canada at the same time.
Yeah, and that's an impressive team. Talk about a confidence in management and plan and track record. That's a company that we're very excited about. Probably a better example is actually one where we've had kind of a very intimate involvement with and kind of a repetitive, there's a company called IMV, it used to be called Immunovaccine out of Quebec City. They're an immuno-oncology, a clinical stage immuno-oncology company that is making kind of immunotherapy more accessible and effective. And we started tracking them back in 2015. We raised them, I think we co-led an $8 million deal at 50 cents in June of 2016. Then we launched coverage on them. Then we did a $8 million deal at 75 cents in December, then another $10 million in June of 17 at $1.30, then another $14.5 million in January of 18 at $2. Actually, FTQ invested alongside that, $5.75 million. It's our top pick. That's how we like to work with our partner companies, where we establish high trust, and we can be very effective in terms of being able to make sure our institutional clients and our individual clients, understand the company very well.
OK, good. Déborah, on a combien de temps?
En fait, le temps a été coupé.
D'accord.
Je vous laisserai quand même conclure avant de passer la parole à notre public si jamais il y a des questions, parce que le Québec est prêt.
Ah, okay. Québec est prêt. Merci beaucoup. Merci beaucoup à tout le monde. Est-ce qu'on a du temps pour une question?
Oui, bien sûr, oui, tout à fait. Donc, je ne sais pas s'il y a des questions dans la salle ou... Oui, monsieur. I'd like to understand exactly what Echelon Wealth Partners do
for Sure. So Echelon is a Canadian mid-sized independent capital markets and wealth management firm. So what that means is we have a capital markets group that focuses on small to medium-sized growing businesses. We raise them capital, whether that's equity or debt. And then we also provide an active M&A services, as well as a whole suite of advisory services. So we become kind of an extension of the company's management team, is kind of how we like to approach it. And then on our wealth management side, we have 58 advisor teams with about $5.4 billion worth of individual investors' assets that are managed on a kind of a holistic wealth management approach.